Okay. Good afternoon, everybody. I do not know whether you are able to hear me. We just want to kickstart our session today. Maybe let me get a thumbs up for a confirmation. Thank you. That was very prompt. I can see that you can hear me very clearly. We want to begin our session for today. Thank you so much. Wow, I appreciate, we are almost 700 of us here, almost. Thank you so much for making time to join today's session. And let me introduce myself. My name is Brenda Mutai from the Kenya Revenue Authority Tax Education Division. I will be your moderator for the day. And before I move much further, I would like us to start off with a word of prayer. Let me invite my colleague, Margaret. I don't know, Maggie, whether you can hear us.
Hello, Brenda. I can hear you.
Loud and clear. Please proceed and open for us with a word of prayer. And then, yes, you see the thumbs up are yours. They can see you. They can hear you. Sorry.
Oh, great. Thank you.
Please pray for us.
Okay, let us pray. Heavenly Father, we thank you for this afternoon. We thank you for the gift of life and for enabling us to assemble here for this training. As we start the training, may you be with us. May you guide our presenters for the day. And even as participants in this training, may you help us, O Lord, to be able to understand whatever that will be presented today. And may you help us to be able to implement it. For we pray this shortly, believing and trusting in Jesus' name. Amen.
Amen. Thank you. Thank you very much for every person who has made time to join today's sensitization. We have come, many of us from the Kenya Revenue Authority. I'll be introducing our team very shortly, but I want to begin by sending our sincere gratitude to the team at the Kenya National Hospital, KNH. Mr. Nelson and your team, thank you so much for inviting us for this sensitization. Indeed, our topic today is very important. We are going to be talking about the Finance Act 2023 and particularly touching on how it affects you as a healthcare worker. Thank you so much for the hand claps. I can see them. Even as we proceed with our conversation today, I want to welcome as many of us to post your questions under the Q&A section. I know some of you might have questions to do with the CPD points and other questions, but I want to welcome us to ask the Finance Act related questions or tax related questions from today's sensitization. What would you want addressed? What would you want clarified? We have a very able team here with us, and I want to introduce them just to unmute and give us their opening remarks before we get started with our presentation today. I want to introduce our panelists from the Corporate Policy Unit, that is under domestic taxes. Now, they all work with the National Treasury. I hope you can hear me. Thank you. They all work with Treasury in the budget development process, and they are also involved in the development of various tax policies at the National Treasury. I want to start off with Christine Majani, who is also a CPA, a certified public accountant. Christine, wherever you are, maybe you can unmute yourself, greet us, and give us your opening remarks. Christine, karibu.
Thank you, Brenda. Thanks, Brenda. Please confirm you can hear me.
Your audio is very crisp, clear, very, very clear. We can hear you very well, Christine.
Oh, okay, thank you. Good afternoon, everyone. My name is Christine Majani from Corporate Policy Unit here at KRA. I'm part of the team that will be taking you through the changes to the various tax statutes brought about by the Finance Act 2023. Um, Thanks for making time to be with us and looking forward to an interactive session. Thank you.
Thank you very much, Christine. I have one question for you. Christine, what do you do for fun? Just apart from corporate policy matters, what do you do?
I love to cook, particularly bake. So in my free time, you'll be finding me trying out recipes.
Aha, fantastic. Christina, now I know that you are a baker. I'll be looking for you after this meeting. Let's
Welcome.
Thank you very much, Christine. I also want to welcome your colleague right there at Corporate Policies, Mr. Ure Silas. Can you hear us?
Oh, good afternoon. I hope I'm audible.
Very audible, Mr. Ure. We can hear you. Please,
Yes. So
yes.
I am Silas Ore. I work in corporate policy, as you've stated, and strategy, innovation, and risk management department. I am happy to join you in this particular session to take our taxpayers through the various amendments to the various tax laws via the Finance Act of 2023. And we welcome clarification questions that they would have on those particular areas so that we can improve compliance among our taxpayers. So thank you so much, and we hope to interact as we continue.
Mr. Ore, it's such an honor to have you here with us. Just the same question I asked Christine. What do you do in your pastime? What do you do for fun?
Yeah, for me, I do two things. I write a lot, mostly for fun, but I also do read novels and other literature. Thank
Okay.
you.
What do you write? You write poems?
No, I try to write songs, though I have
Ah.
not, I have not managed really to have any tangible or album, so to speak. Thank you.
Thank you so much, Mr. Ore. Indeed, we will be hearing more from you in just a moment. Allow me to bring on board our very first panelist for today. I want to introduce her shortly. Even as I welcome us to comment on where we are listening in from, I'm made to understand that you are listening to us from across the country. So you can represent the county from where you're listening to us. Paulino Wino is saying that you can hear us very loud and clear. Thank you very much. I already see the questions that have already started streaming in from the likes of Elijah Karaoke. We see your questions. I want to introduce our first panelist for today to be none other um, than Polly Kibue. Pardon my pronunciation of the second name, I think I should be saying Kefue. She's from the Domestic Taxes Department. She's a manager there and a policy and tax advisory unit. So she also participates uh, in the development process of the budget. This is under Treasury, and she also is involved in the development of various tax policies still at the National Treasury. Please let us put our hands together and appreciate Polly Kefue. She's coming to take us through the changes in the Income Tax Act. I don't know, Polly, if you can hear us. Yes, are you
I
able
can
to?
hear you. I can hear you.
Thank you. Thank you so much. I can see the hand claps. The appreciations are for you. Uh, Kindly just give us your opening remarks before we go to the presentation.
All right. Thank you so much. You can hear me.
Yes, we can hear you. We can hear you very clearly.
Okay. My name is Polly Kibui, and I'll take you through the changes that were made to the Income Tax Act by the Finance Act 2023. Can I go right into it?
Yes, please. Kindly just go right into it. We have begun the presentation. Thank you.
Thank you. Thank you so much. And welcome to this presentation. So the first definition is really to clarify the definition of winnings. Previously, there was some ambiguity as to whether withholding tax would be applied on net winnings or gross winnings. So the Finance Act 2023 has come in to clarify that withholding tax of 20% will be applied on net winnings. So the second was to introduce the Finance Act 2023 introduced the term digital content monetization, and then the Finance Act has gone ahead to provide for withholding tax of 5% for resident and 20% for non-resident on digital content monetization. The Finance Act 2023 expanded the definition of immovable property to include land, whether covered by water or not. Previously, the definition was talking about mining rights, petroleum rights, so land was not covered. So now this is now covered by the Finance Act 2023. So Finance Act 2023 also moved the term related person from the 8th schedule to the section 2 of the Income Tax Act to apply it to the whole Income Tax Act. So when it was in the 8th schedule, it only applied to that schedule, but now the term related person, as it is been defined by the Finance Act 2023, will apply to the whole Act. So some amendments were made to Section 5, that is on taxation of employment income, and one of them was to exclude amounts received by an employee as payment of traveling allowance to perform official duties from taxation as a gain or benefit from employment. The allowance shall be pegged on the standard mileage rate approved by the Automobile Association of Kenya. So the effective date of this is 1st July 2023. So the Finance Act also has introduced taxation on club entrance and subscription fees allowed against employer's income on the employee. So when the employer pays this club entrance fees, subscription fees, they'll be charged as a benefit on the employee. So the Finance Act went ahead and clarified that the date to be considered when determining the market value of a share is the date when the employee exercises the option as opposed to the date when the shares are granted by the employer. This is to do with the employee share ownership plan. So the effective date is 1st July 2023. This is just to align to what was provided for in the Finance Act 2022. Can you confirm if there is noise in my background?
Yes, there's some slight noise from your background, though we can hear you, but there's some bit of noise from your background. And then also,
Yeah.
we want to kindly request if it is possible to put the slides on slideshow. Yes, now there's quite some noise.
Some noise.
Initially,
Okay, let me just give me a minute. It's my colleagues. I'm sorry about that. Let me.
All right, it's okay. Thank you very much. Even as we're giving Madam Kifue an opportunity to just manage her surrounding, I want to appreciate the kind of questions that we are receiving today. Elijah Kariuki, I hope you're able to hear us. I have not heard anybody else talk about the audio getting poor. I think you should be able to hear us. Just comment on it. So then I see the kind of questions that we are getting, even as I welcome Mrs. Kifue, Madam Kifue to continue. There is a question, maybe let us finish with the presentation on the Income Tax Act, and then we will take very few questions on the Income Tax Act before we proceed to the other panelists. So you are okay to proceed?
Yeah, thank you. Is it okay? Is it better now?
Yes, it is. It is better. It is.
Thank you. Thank you so much. So the Finance Act deferred taxation of the benefit of shares in lieu. These are the ones that are offered by eligible startup. The term eligible startup is also provided for by the Finance Act 2023. So now the Finance Act 2023 provided that where an employee is offered company shares in lieu of cash emoluments by an eligible startup, the taxation of that benefit is deferred for a period of 5 years. Or when the,
But my
sorry,
sincere apologies. I don't mean to interrupt. I don't know whether it's possible for you to place the slides on slideshow mode. It's come as a request by many of our listeners. I think they'll have a better view of it just below on your bottom right.
is it that way or not yet?
Uh, okay, not quite there
Not
yet.
yet.
Yes.
I can, Christine,
Okay.
Silas,
Yes.
Christine, can you share for me, please?
Okay.
Yeah.
Thank you. Thank you for that. I think we've received numerous requests to have it on slideshow, so we can do that for their benefit. As Christine is sharing the slides for us, she's putting it up.
Oh, shucks.
Christine, thank you. We can see the presentation. Yes, thank you. Thank you very much. We can see it very clearly now. Thank you. So Polly can proceed.
Okay, sorry for that, but let's proceed. As I was saying, now the Finance Act 2023 has deferred the taxation of benefit of shares allocated to an employee in an eligible startup to a period of 5 years, or when the employee sells the shares, disposes of the shares, or leaves the employment of the eligible startup. So the Finance Act 2023 lowered the upper threshold for turnover tax to 25 million. So that means that turnover tax will apply to a threshold of between 1 million and 25 million. And the rate was increased to 3% from the previous 1%. So the Finance Act introduced the digital asset tax at the rate of 3%. Christine, we can move. No, the previous one, Christine. Yes, that one. Thank you. So the Finance Act has also amended the Income Tax Act to provide that individuals to claim mortgage interest expense incurred on money borrowed from a cooperative society. So the Finance Act 2023 has also introduced a new section 16(1)(c) of the Income Tax Act to provide that any expenditure or loss shall not be deductible if the invoices of the transactions are not generated from an electronic tax invoicing management system, that is ETIMS. So previously this has been happening for VAT. So this has been extended. This requirement has been extended to income tax. The effective date for income tax for this provision is 1st January 2024. So the Finance Act 2023 introduced a post-retirement medical fund relief where resident individuals contribute to a post-retirement medical fund. So the relief shall be 15% of the contribution or 60,000 per annum, whichever is the lower. So the Finance Act also introduced withholding tax on some payments, one of which is sales, promotion, marketing, advertising services for residents. Already, these services attract withholding tax for non-resident. So now this has been extended to residents at the rate of 5%. So as I had mentioned earlier, the withholding tax rate for digital content monetization is 5% for residents and 20% for non-residents. So the Finance Act 2023 provided for appointment by the Commissioner in writing of persons who receive rent on behalf of property owners. So we call them property agents who receive rent on behalf of landlords as withholding rental income income tax agents. So that has been provided for by the Act. So the Finance Act 2023 amended Section 35(5) of the Income Tax Act to provide that withholding taxes should be remitted to the Commissioner within 5 working days. Previously, it was after 20th of the month following the deduction. So now this has been amended to be that withholding taxes, all withholding income taxes should be remitted to the Commissioner within 5 working days. Christine, thank you. So some income now has been exempted from income tax, and this include royalties and interest paid to a non-resident person by a company undertaking the manufacture of human vaccines, investment income from a post-retirement medical fund, whether or not the fund is part of a retirement benefit scheme, income earned by a non-resident contractor, subcontractor, consultant, or employee involved in the implementation of a project financed through a 100% grant and an agreement between the government and the development partner to the extent provided for in the agreement, gains on transfer of property within an SEZ, so Special Economic Zone enterprise developer and operator, royalties, interest, management fees, professional fees, training fees, consultancy fee, agency fee, or construction fees paid by an SEZ developer, operator, or enterprise in the first 10 years of its establishment to a non-resident person. So the income tax has been amended to provide by the Finance Act 2023 to provide for two individual tax rates, tax bands, which are 32.5% and 35%. For income between 500,000 to 800,000 per month, they will attract an individual tax rate of 32.5%. For income above 800,000 per month, it will attract the rate of 35%. The effective date of this was 1st July 2023. So the rate of MRI, or residential rental income tax, has been reduced from 10% to 7.5%. The effective date of this is 1st January 2024. So also the Finance Act 2023 has included mortgage refinance companies licensed under the CPK Act to be included as part of the financial institutions in the fourth schedule. The Finance Act 2023 also introduced an anti-abuse clause where property is transferred in a transaction that is not subject to CGT and is subsequently transferred within 5 years. Then the Finance Act, finally, these are just the ones that are, there are more amendments, but some might not be relevant because they are to do with transfer pricing. So finally, on this one, we have the Finance Act 2023 has provided for change of due date for capital gains tax to be the earlier of receipt of full purchase price by the vendor or registration of the transfer. So that's a change in the due date for capital gains tax. So the effective date for this is 1st July 2023. That's the end of the presentation for income tax. Back to you.
Thank you.
Um,
Thank you so much, Polly. Let's appreciate her for that presentation that she has taken us through the changes in the Income Tax Act. Yes, thank you so much for those who are appreciating her. But before I let you go, Madam Polly, I just want to pick out two questions here that have come, and we have some of our listeners who would like answers to some of their questions. There is one anonymous attendee. They didn't leave us a name, but they asked how the new tax laws affect them in their private practice. I don't know whether you can comment on that.
Come again. And Silas, Christine, you can as well assist me in answering the questions.
All right.
Come
The
again.
question,
Mm.
thank you so much. How does the new tax law, how does it, the changes in the Finance Act 2023 in their practice, how does it affect them in their private practice?
I really don't get the question, but really what I could say is, if there are changes in the rates, if there are changes in the implementation in how, like for withholding taxes, that would affect them, for instance, that they're now to be remitted within 5 working days. There is the change in the individual tax rate of 32.5, 35%. Compliance, they have to comply with what now is, because the court gave us the go-ahead to implement the Finance Act 2023. So, so they really just have to comply with what is provided for by the Finance Act 2023.
All right. Thank you so much. There's a follow-up question here by Mabel Nangami. She's saying, how much is the capital gains tax in terms of percentages? What is it?
It's 15%. Remember, in Finance Act 2022, it was increased to 15% from 5%. So currently it's 15%.
All right, Mabel, I hope you have gotten the response. It's 15%. Edwin Ochoma is asking, are there any changes in the taxation of part-time jobs?
Maybe we could encourage participants to just listen through the presentation, then we'll be able to pick out what affects what, because we're getting there.
All right, okay. Let us not jump the horses. All right, fine. Let's now go to our second presenter because we're coming to take the questions very soon. Christine, you're actually the one to continue on with the discussion. I know you're taking us through VAT and excise duty.
Yes.
Karibu sana.
Thank you. So I'll take you through through the changes to the VAT Act that are brought about by this Finance Act 2023. So to start with is what we are all aware of, VAT on petroleum products is now taxable at 16%. We are all affected by this. It's already being implemented. Then liquefied petroleum gas, LPG, this was taxable at 8% previously. The Finance Act 2023 has come to change that to make this zero rated for VAT. So suppliers of LPG gas shall be able to claim input tax on, their supplies. Then another amendment to the VAT Act is on Section 17. So the Act has been amended to require that taxpayers who are seeking input tax credits will be required to evidence that the VAT in question has also been declared on a VAT return to the KRA. So we are just saying that both conditions of requisite documentation and also declaration of sales invoice by the supplier shall need to be fulfilled before a claim of input tax is approved. Then next we have insurance compensation. There's been a lot of talk on this. Does it mean that whatever compensation you and I receive when my car gets knocked, when my property is destroyed in a fire, that is not what we're talking about. So this provision is talking about compensation received for registered persons who are dealing with, we're talking about stock in trade. So where a registered person has lost or damaged stock, we are saying that when your insurer compensates you for that loss, then the amount of VAT claimed initially on this shall be declared to the KRA. So this is just to ensure that taxpayers do not benefit from an input VAT deduction on the goods where someone is compensated for loss without accounting for the corresponding output VAT. Then the law has also been amended to provide for a refund of VAT on a supply to a registered person where the person to whom the supply was made has been placed under statutory management. So previously, taxpayers were required to obtain a liquidation order for a refund of VAT, but now the law has been changed to allow that these refunds shall be given even where a supplier has been placed under statutory management, and this application should be made within 10 years from the date of supply. Previously, it was 4 years. And also, in case one is able to recover this money, they shall refund it to the commissioner within 60 days of the date of recovery. Then another amendment is on the suppliers of imported digital services. The law has been changed to require that they shall register for VAT, whether or not the taxable supplies meet the 5 million turnover threshold. So we know that the threshold for VAT is 5 million, but in the case of imported digital services, whatever the value of their supplies, they should register for VAT. Another amendment to the Act, currently, the way the Act reads in Section 43, it talks of records being kept in Kenya, but with the advent of the digital age and technological advancements, we know that taxpayers can keep records anywhere. So this amendment was just removing this requirement for registered persons to keep these records in Kenya. Then moving on, certain new exemptions in the VAT Act, the first schedule to the VAT Act that deals with the exempt goods. The Act has been amended to provide that local purchases of plant and machinery by manufacturers of pharmaceutical products or investors in the manufacture of pharmaceutical products shall be exempt, but this is upon recommendation of the CS for Health and approved by the CS for the National Treasury. Then another exemption is on the taxable supplies made to or by a school feeding program recognized by the CS for education. Then the Act has been amended to introduce a certain number of zero-rated supplies. So to start with, the exportation of taxable services. So previously, Finance Act 2022 removed, or rather made taxable services, the export of taxable services, with the exception of those relating to business process outsourcing, taxable. So this is now zero rated. LPG gas, as we had mentioned previously, has moved from 8% to zero rate. The supply of locally assembled and manufactured mobile phones, this is also now VAT-able at zero rate. The supply of motorcycles of tariff heading 8711, this is also zero rated. Supply of electric bicycles, the supply of solar and lithium ion batteries, the supply of electric buses. So this is just in support of the government's green agenda and heading towards the use of clean energy. Then inputs or raw materials locally purchased or imported for the manufacture of animal feeds. These are zero rated as well. And also bioethanol vapor stoves. So cooking appliances and plate warmers for liquid fuels. These are now zero rated. So the zero rating of products is a welcome move because it means that suppliers are able to claim input tax, and so since that VAT is not being passed on to the consumer, then the prices can be, slightly lower for such supplies. So that is all the amendments that we feel are relevant to the VAT Act. I'll hand it back over to Brenda before I move on to the Excise Duty Act.
Thank you so much, Christine, for taking us through that. Let's appreciate her. I know she has tried to make it as concise as possible. Thank you, Christine. I know the next presenter is going to be talking to us regarding the Tax Procedures Act together with the Employment Act. But I would like us to just pick a few questions here. They are in relation to just what you've talked about. For example, we have a question here by John Masasabi, and he's asking, I think you've already touched on it, but maybe you can repeat it for his sake and others like himself. The question is, what are the differences or what are the implications between tax exemption and zero rating on goods? They are
Okay.
trying to understand, yes.
Okay, thanks for that. So VAT supplies are classified in three categories. So there is exempt goods, or rather exempt supplies, because when you talk about supplies, we're talking about both goods and services. So there is exempt supplies. So for exempt supplies, VAT is not chargeable on this. Then there is zero-rated supplies. Zero-rated supplies, VAT is chargeable, but at 0%. So you buy a product, maybe the product you're buying was chargeable, VAT was chargeable at 16%. And then but you cannot charge VAT on it, or rather the charge for VAT on it is 0%. So it means you are allowed to claim the input tax that you paid on that product. So the rate there is 0%. Then there is supplies that are taxable at standard rate, that is 16%. So most of the goods fall here. When you and I go to the supermarket and buy goods, when we procure certain services, we are charged VAT at 16%. So we are saying the VAT chargeable is 16%. So the difference comes in between exempt and zero rated. So exempt supplies, the input tax that was charged on them is not claimable. It's not recoverable because they are exempt, not chargeable to VAT. But for zero rated supplies, input tax is deductible. So at the end, when accounting for the VAT, we know the accounting is output VAT minus input. So for exempt supplies, you're not allowed to recover the VAT on this. For zero rated supplies, the input VAT is recoverable. I hope that is clear.
Thank you so much, Christine, for that response. John Masatabi, I hope it is very, very clear now. You can tell the difference between goods that are zero rated and those that are exempt. That is in as far as VAT is concerned. Allow me to just ask a few more questions before we move on to our next speaker so that we can be able to respond to their questions. Now, there's a question here, two questions, Christine. So there's a question. The anonymous attendee is asking, the act says that expenditure will all need teams. I think you can understand his question. So he's asking, will need e-teams. The question that came in at 2:35 p.m. I think you should be able to see it in the Q&A section. The act says that expenditure will all need e-teams. What about locums and casual staff? How will it, or how will that work?
Okay, thanks for that. Maybe Brenda, if you could just allow us to defer that question up until the presentation on tax procedures, where my colleague will touch on e-teams, please.
Fantastic, that's okay. Then with that cue, then allow me to welcome our third panelist for the day, who's going to tackle the matter to do with the Tax Procedures Act and also Employment Act, none other than Mr. Silas Oure. Kindly please feel free to unmute and take us through the next section.
Brenda,
Let's appreciate him. Yes.
I was just to finish something small on excise duty before my colleague Ore comes in.
No
So let me
problem.
just, yeah.
All right, please feel free to continue.
Okay. So just touching very briefly on the excise duty provisions of the Finance Act 2023. So first of which is Section 10 of the Excise Duty Act has now been deleted. We might all be aware of the adjustments for inflation. So every year in October, KRA would issue a statement adjusting the rates, the specific rates of excise duty on various items. So this has been deleted. Yes, we do listen to our taxpayers when they say that we are revising rates in June. Come October, rates are being adjusted again for inflation. So the government listened to you and deleted this provision. Next, the Finance Act is just introducing an offense and fine of being in possession of excisable goods affixed with counterfeit excise stamps, or possession of excisable goods on which excise stamps have not been affixed. So previously, these offenses and fines were resident in the excise duty excisable goods management system regulations. So they're just being anchored in the main act, the Excise Duty Act. Then the Act has also amended the Excise Duty Act to introduce payment of excise duty within 24 hours from closure of transactions of the day in respect to betting and gaming offered through a platform or other medium. It also goes ahead to define closure of transactions of the day to mean midnight of that day. Then the Act is also empowering the Commissioner to require taxpayers in any sector to remit excise duty collected on certain excisable services within 24 hours from the closure of transactions of the day. Electric motorcycles are being excluded from the imposition of excise duty. Then there's an amendment to provide that only imported articles of plastics will now attract excise duty. So previously, excise duty was imposed on all articles of plastic. Then disassembled or unassembled kits for local assembly or manufacture of mobile phones, this will now be exempt from excise duty going forward. The effective dates of most of these amendments that I'm talking about was 1st of July 2023. Then certain amendments to the first schedule that deals with the rates of excise duty. So first of which is imported glass bottles. We're excluding imported glass bottles for packaging of pharmaceutical products. The rate of excise duty is being increased by 10%. Then there are those items number 2 to 7. I won't bore you with reading through all of them, but most of them are ingredients used in the manufacture of paints, varnishes, and the like. The rates of excise duty have been increased by 10% from 10 to 20% each. Then various changes to the rates of excise duty. You might be interested in some of this that we use on day to day. So telephone and internet data services, the rates of excise duty have been reduced by 5% from 20 to 15. Same as the fees charged for money transfer services by banks, money transfer agencies, and other financial service providers. The fees for money transfer services by cellular phone service providers and payment service providers licensed under the NPS Act the rate has been increased by 3% from 12 to 15. You might have seen the notice by Safaricom saying they're increasing their rates of their charges of money transfer services. Then excise duty rate on betting, gaming, prize competition, and lottery. This has been increased by 5%. The Finance Act 2022 imposed 7.5%. This is increasing this year again by 5% to 12.5. Then advertisements on television, print media, billboards, and radio stations on alcohol, betting, gaming. The rate of excise duty is 15%. This was non-existent before. Then there are certain new items that will now be chargeable to excise duty. I'll mention a few, as you can see in the list there. Imported fish will be chargeable at 10%. Powdered juice, 25 shillings per kg. Imported sugar, so excluding imported sugar purchased by a registered pharmaceutical manufacturer. A lot of packs for pharmaceutical manufacturers here. Now at 5 shillings per kg. Imported cement also will be chargeable to excise duty. Imported furniture of that tariff heading, excluding furniture originating from EAC partner states. Cell phones imported will now be chargeable to excise duty. The rest of the items there, you will see the rates of excise duty, as you can see there. Imported paints, varnishes, lacquers, and all the rest that you can see there. Imported cartons, boxes, and the like. Imported plastics, now chargeable to excise duty at 25%. That brings me to the end of the amendments to the Excise Duty Act. Thank you.
All right, thank you so much. Let's appreciate our very own Christine for taking us through the changes in the Excise Duty Act. I know they are paying very keen attention. I could see their responses even as you were going through the different changes in the Excise Duty Act. So then let us hold the questions until after the last panelist has spoken, but you can still post them on the chat box. Be assured that we will be trying to answer all of them, answer as many as possible within the time that we have been allocated. So then, Mr. Ore, allow me to just welcome you to proceed from here. If you can feel
Okay.
free to unmute.
Thank you so much. So I'll take you through the changes to the Tax Procedures Act and I think the Employment Act and another one. So tax procedures deals with procedures, as you are aware. So these are procedures which are cutting across all taxes which are administered by the commissioner. So the first amendment is with regard to a refund decision. That will not be a tax decision, and late payment interest is a tax decision and subject to objection. So what this amendment says is that first there was an amendment last year. That amendment affected section 47 of the Tax Procedures Act. And that amendment said that if there is an overpayment of tax by a taxpayer, then the taxpayer can, one, utilize that particular overpayment to pay future tax liabilities. And secondly, the amendment provided that the taxpayer can as well apply to the commissioner for a refund. The mistake that happened then is that that provision went ahead and said that in the event that the taxpayer is not satisfied with the decision, with the refund decision, then that has been done by the commissioner, then that taxpayer is free to go to the tax appeals tribunal and appeal. But then if you look at the law clearly, the law says that a refund decision cannot be appealed. So on one hand, one says you can appeal to the TAT, and on the other hand, one says you cannot appeal. So what was done this year was simply to delete tax decision, refund decision from the definition of a tax decision, because a tax decision is what cannot be appealed, but a refund decision is one of the tax decisions. So that was just to make it clear. The second amendment was with regard to trustees. We have Kenyan trustees. They are administering trust, both for residents and non-residents. Previously, the law required that such trustees are supposed to keep documents and file them with the commissioner if the income of the trust is taxable in Kenya. So this left out those trusts which are administered by our resident trustees whose income are not taxable in Kenya. So this time, the law has been changed to provide that if you are a resident trustees and you are administering a trust, whether a trust that is resident or non-resident, then irrespective of whether the income is taxable in Kenya or not, you must keep records and file with the commissioner. So this is meant to provide visibility of what trustees do. The next amendment is with respect to an electronic system. Polly talked about this under Income Tax Act, where it is a requirement that invoices are issued through e-Teams. So this particular provision has also been brought under the Tax Procedures Act so that it cuts across all taxes. So there will be a requirement that invoices, or there is a requirement, or rather, that invoices must be issued through e-Teams, be they for VAT, be they for excise, be they for VAT, and any other tax that the commissioner is administering. However, the law has excluded certain transactions from the issuance of electronic invoices. And I think this is one of the questions that a participant asked. So what are these which have been excluded? So one of them are emoluments, 2 are imports, 3 are investment allowances, interest, and those similar payments. So if we have those kind of similar payments, for instance, when salary is paid to an employee, no e-Teams invoice is required. So the law has clearly delineated from certain transactions from the requirement of e-Teams. And again, the law is giving the commissioner power that in the event a taxpayer is unable, for one reason or the other, to use e-Teams to issue electronic tax invoices, then that taxpayer will write to the commissioner to explain himself why he cannot issue electronic invoices. So the commissioner will look at this case by case. If he's satisfied, then he will put it in a notice that this taxpayer has been exempted from the issuance of e-Teams. So this will majorly cover small taxpayers, the SMEs. They may not be able to issue probably electronic invoices using e-Teams. However, this is on a case by case. The next one is a provision that previously gave the commissioner power to abandon taxes. This provision has been deleted. The commissioner had power to abandon taxes if he is unable to collect it for one reason or the other. And the law clearly specified, for instance, if it is impossible to collect, if there is undue difficulty to collect, if there is hardship in collecting, then the law gave the commissioner power to abandon those taxes. So this power has been removed. It is not there. So the commissioner cannot abandon taxes. That implies that those taxes which will not be collectible will remain in our system. Related to this is a provision that previously required the commissioner or gave power to the commissioner to remit or to forgive, so to speak, interest and penalties up to 1.5 million Kenya shillings. So one could apply to the commissioner. Then you say that you are requesting to be forgiven certain interest and penalties. So the law gave the commissioner power to remit those penalties. That particular law also provided that if a taxpayer is requesting for remission of interest and penalties which are above 1.5 million Kenya shillings, then the commissioner would seek the authority of the CS National Treasury. So that provision has also been deleted. So what does this mean? It therefore means that if you incur, if you have interest and penalties, and the provision doesn't exist, then the commissioner will not have power to remit those interests and penalties. However, there is good news that I will talk about when I reach there. So the next one is with respect, yes, it is the next one actually, an introduction of an amnesty on penalties and interest for principal taxes due before the 31st December 2022. So I have said that the provision to remit penalties and interest has been deleted, but the government has brought in an amnesty for interest and penalties. So what does then the law require? The law says that if you have penalties and interest in the system, and that is iTax, and these interest and penalties are relating to taxes prior to 31st December of 2022, and you do not have any principal tax outstanding for any period before that time, then penalties and interest will be forgiven automatically. So I will explain again that you have interest and penalties in the system relating to periods prior to 31st December 2022, but you don't have any principal tax that you have not paid. Those interest and penalties will be automatically, amnesty will automatically apply to those interest and penalties. So when you wake up on, I think, 1st of September, my expectation is that for those who do not have interest and penalties, for those who do not have principal tax relating to this period, but they have interest and penalties, you will find that those interest and penalties are not in the system. However, for those taxpayers who may be having tax debts relating to the period I am talking about here, of course, that means that they will also have interest and penalties. Those taxpayers have also been given some window of opportunity. And the window of opportunity here is that enter into a payment plan with the commissioner for the principal taxes which are outstanding. Pay those taxes by 30th June of 2024. When you complete payment, you will also get an amnesty for interest and penalties. So this is an important provision for us as taxpayers and even for the authority, so that we can also clean our records and remove those particular interest and penalties. The next amendment is with respect to agency notices. So agency notices, this where the commissioner writes to your bank, for instance, that so and so owes taxes to the authority. Please do not allow any transaction in that account. So that is what an agency notice is. So what the law has done this time is to provide the commissioner with circumstances under which he can place that agency notice, because it was realized that the commissioner was issuing agency notices prematurely. So what are these circumstances? I'll just mention but a few. That one, you have self-assessed yourself. You know that there are taxes that you are supposed to pay by a given or date, but you have refused for some reason to pay. So the commissioner has power at that particular point to ensure that an agency notice is actually given. Next is a situation where the taxpayer has entered into a payment plan with the commissioner. Of course, you know, a payment plan is negotiated between the taxpayer and the commissioner. You've entered into that payment plan for payment of certain taxes, but for one reason or the other, you have refused to obey that payment plan. The commissioner is given power to issue an urgency notice. Again, there are circumstances where the taxpayer has not appealed against an assessment which has been specified in an objection decision within a prescribed period of time. So you have not appealed. You've received it, you've kept quiet. There are timelines within that notice. When those timeline lapses, when the timeline lapses, the commissioner is given power to issue an urgency notice. And again, the taxpayer has not appealed against an assessment specified in a decision of a tribunal of a court. So those are the circumstances under which now the commissioner will be required to issue an urgency notice. Next, I'll be a little bit fast going forward. Now, withholding VAT, the taxpayer will be required to remit this within 5 working days after the deduction. I think you remember what Polly talked about under Income Tax Act, withholding taxes. 5 working days have been provided. So even for withholding VAT, the same has been provided. And again, Polly did mention under Income Tax Act that the commissioner is given power to appoint agents to collect monthly rental taxes and remit to the commissioner. So this provision has also been brought under TPA just to ensure that it covers the entire acts which are administered by the authorities. So there is an introduction of a provision for appointment of rental income tax agents for the purpose of collection and remittance of rental income tax to the commissioner. And of course, the days are still 5 working days. Next. Christine. So the other amendment is with respect to section 47, and this is on offset or refund of overpaid taxes. I'd mentioned that last year, the law amended the act to provide that one can seek for refund of overpaid taxes, and 2, one can apply overpaid taxes for payment of future tax liabilities. What the law didn't provide for is to utilize those overpayment for payment of outstanding debts. And that is what this act is providing, that if there is any outstanding or any overpayment, then that overpayment can as well be used to offset any outstanding debts that the taxpayer may have. And again, on issues of refunds, we are now saying that once a refund has been ascertained, the commissioner only has 6 months within which to pay that particular refund. Initially, it was 24 months. The next amendment is with respect to, requires the commissioner to request the taxpayer to submit the information specified in a notice within 7 days, where a notice of objection lodged by a taxpayer has not been validly lodged. So what this section provides is that the commissioner has 14 days. Let's say that a taxpayer has lodged an objection to a certain decision. The commissioner is given 14 days within which to communicate with the taxpayer if that objection is not validly lodged. So that was amendment last year. This particular year, the taxpayer is being given an opportunity to remedy those situations that led to the decision of the commissioner. So the commissioner is told, fine, you have communicated that this objection was not lodged validly, but then give the taxpayer 7 days, within 7 days, to remedy those particular situations. So the taxpayer can provide additional information just to ensure that the objection will be valid. The next amendment is that in the event that the taxpayer fails to provide that information, within a specified period, then the commissioner will be required to make an objection decision within a period of 60 days. There are taxpayers who have cases with KRA, either in court or in the tribunal, in the tax appeals tribunal. These taxpayers at times go and request the court or the tribunal to settle this issue out of court. So initially, the taxpayer and the authority were required to settle those issues within a period of 90 days, but this has now been increased to 120 days. The next one is with respect to e-TIMS that I talked about. e-TIMS is a system that will be used to issue that is used rather to issue electronic invoices. So what happens to a taxpayer who for one reason or the other does not use e-TIMS to issue invoices? There is a penalty that has been provided, and the penalty is 2 times the tax that is due. So assuming that the tax that is due is 100,000 shillings, you did not issue e-TIMS for that particular invoice, what the commissioner will expect from you as a penalty for non-compliance with e-TIMS is 2 times 100,000, and that is 200,000. I had mentioned about the deletion of the provision on remission of penalties and interest, so we can move to the next. So the next one is on Miscellaneous Fees and Levies Act. So Tax Procedures Act is over. Let me move straight to Miscellaneous Fees and Levies Act. So under the Excise Duty Act, when my colleague Christine was talking about an amendment under Section 10 in that act, which allowed the commissioner to adjust specific rates of excise duty every 1st of October, the Miscellaneous Fees and Levies Act also allowed the commissioner to adjust the specific rates of export levy to take into account inflation. So the provision under excise duty was deleted, and again the provision under Miscellaneous Fees and Levies Act has also been deleted. So this is to the benefit of the taxpayers. There is also harmonization of IDF and RDL rates by removing the preferential lower rate of 1.5%. So all the rates have been harmonized, or IDF rate has been harmonized or reduced rather from 3.5% to 2.5%. So this majorly deal with those who do imports. For the Railway Development Levy, that is the RDL, the rate has been reduced from 2% to 1.5%. Then the Act has introduced another schedule, actually a third schedule to this Act. And the schedule is titled Export and Investment Promotion Levy. So this is a new levy. And this is paid by the importers of certain goods. So if you look at those, if you look at the Finance Act, you will see those goods. And therefore, the rates are either 17.5% or 10%, depending on what item or you are looking at. There is also the reduction of the ad valorem rates of export levy from 80% to 50%, and specific rate from US dollars 0.55 to US dollars 0.32. So all these are actually meant to encourage the development of manufacturing sector in the country, because most of these are actually dealing with imports, and imports are used mostly for in the manufacturing sector. So the next one is employment, and this is the last one. Probably I'll talk about it for 5 minutes because I know there are questions about it, some of which I may not answer, but I will try as much as possible. So Employment Act 2007. So this is not a revenue act from the word go. It isn't a revenue act. So naturally, it should not be implemented by KRA. And of course, it is not implemented by KRA. So I will tell you the role that KRA does under the Affordable Housing Levy. So each employee and employer shall pay the Affordable Housing Levy at the rate of 1.5% of the employee's gross monthly salary. So there is no ceiling. So it is very progressive, very equitable, because those who earn less will pay less, those who earn more will pay more. In the Finance Bill of 2023, which was enacted into the Act, there was a ceiling of 2,500. So that ceiling was removed by Parliament. It is not there. So assuming that you're earning 100,000 Kenya shillings, as your gross pay, 1.5% of that pay will go towards the Affordable Housing Levy. The employers are also expected to match this contribution to that levy. So employers will also pay 1.5% of the employee's gross monthly salary. So I hope up to there we are clear. Now, on 3rd of August of 2023, or even before I go to 3rd, you are aware that this act was taken to court. However, the court lifted the order that had suspended its implementation. So that therefore meant that the government was now at liberty to implement the provisions of the Finance Act, one of which is Affordable Housing Levy. So on 3rd of August of 2023, the State Department of Housing and Urban Development, who are actually the owners of the Affordable Housing Levy, issued a public notice. So in that public notice, that State Department said that the Affordable Housing Levy is going to be backdated from the 1st of July 2023. Why? Because the court did not tell them not to backdate it. So there are people whose payrolls had been generated by the time the court decision came up, so they got their full amount. However, employers will still be expected to recover the July Affordable Housing Levy from their payslips. On how they will do it, they can do it in 1 month, they can decide to do it in 2 months, 3 months, or 4 months. So that is the first clarification. In that particular public notice, the State Department of Housing and Urban Development appointed KRA as a collecting agent. So that is where we come in. KRA comes in as a collecting agent, meaning we've been appointed, we are told, please collect on our behalf. And that is what our role is, that we are going to collect the Affordable Housing Levy on behalf of the State Department of Housing and Urban Development. So that was another issue that was in that public notice. The third issue was the date for remittance of this Affordable Housing Levy. The date of remittance, the public notice said 9. Yes, so the public notice said 9 working days after the end of the month that deduction relate to. So upon being appointed as a collecting agent, KRA issued a public notice. And in that public notice, what we said is that we provided for the mode of payment. So we said there is an additional sheet in the pay as you earn return where you will declare the affordable housing levy. But we also reminded taxpayers that in the event that you fail to deduct the affordable housing levy, then there will be payment of penalty of 2% per month. Yesterday or today, we issued another public notice on the same, and we were trying to clarify because people were asking, what is this gross salary? What does it include? So we clarified today in a public notice, and we said this, that gross monthly salary constitutes basic salary and regular cash allowances. So what are these regular cash allowances? You are given commute allowance every month, or regularly rather. You are given housing allowance regularly. These are regular cash allowances. You are given, for instance, or car allowances if they are regular, and any such regular cash payments. So that will be the base for calculating the affordable housing levy. It is basic salary and regular cash allowances. So what are not included? Any benefit that is non-cash, you are given a benefit that is not paid in cash, as well as allowances which are given to you, which are not regular. And what are these allowances? Leave allowance, for instance, it is paid once per year. Bonuses, gratuity, pension, severance or payment, or any other terminal dues and benefits. So that's the clarification that we did today. The second clarification is that affordable housing levy will apply to all employees irrespective of their contract of service. So it doesn't matter whether you are on PNP, whether you are on a 1 month contract, 2 months, affordable housing levy will be paid. And finally, I know that time is not on my side. This is a levy. In the bill, there was the provision that those people who pay this levy will get houses. In the bill, it was a fund. So we were told, or the bill said, you can get a house. If you don't get a house, you can get back your money after 7 years. Or you can transfer this money to any beneficiary. So those were in the bill when the model was the model of a fund. But in the Act, this is a levy. And as such, we do not expect, for instance, that because I am paying it, that I will get a house. So I want to stop at that point. And thank you for listening. I think I've clarified all the issues around the affordable housing levy. So back to Brenda.
Thank you so much. Thank you so much, Mr. Ore. You're such a meticulous teacher. You're moving step by step in a tone that is very, you're a good teacher. Thank you so much, together with our other panelists, Christine Majani and Polly Kifwe. Thank you so much. I can see the hand claps are for you. Come on, let's appreciate him. He's done a fantastic job. And with the it's a virtual training, so we are not really able to see our taxpayers or our listeners, but I can assure you the kind of silence that was you could be following your presentation, particularly when you are speaking about the housing levy. and the last slide under the Employment Act, and just demystifying what came with the housing levy. Thank you so much for that. I want us to very quickly, because time is really well spent, to just touch on a few questions that have come before we call it a day. I think Christine and Silas, together with Polly, is it okay if we juggle the questions between the three of you or the two of you? Christine, perhaps you can guide me, and Mr. Ore.
That's fine. Any of us will answer. Will come in.
All right, thank you so much. Let me just stick with Mr. Ore first, because there are a number of questions that have come up still on the housing levy, and perhaps you can just respond to them. Um, I think let me just ask them as they are. Maybe ask three of them, and then you can respond to them. On housing levy, still a clarification on the refund part that you talked about at the very end. Somebody's asking, will we get a refund after 7 years? Who will pay that? One question. Shamala is asking, what does that mean that you cannot get a house? I think you might need to comment on that as well. Uh, she says that I thought you can get the house if your salary or income is 50,000 shillings or less. So you can touch on that. And one other question that I saw here, still on housing levy, still as a person asking, does it mean that you will not get back the housing levy in case you do not uh, get a house and work two jobs? Does that mean that you will pay the housing levy twice? Maybe you can just talk about this, Mr. Aure.
So thank you. So, okay, let me just, I want to restrict myself to what the finance has provided. So there is no refund. I think that is clear. That was in the bill. And at that particular time, this thing was modeled along the lines of a fund. So we contribute, say that fund, you didn't get interest. That was deleted. So now it is a levy. By the way, we pay petroleum development levy or something like that, or pay many levies. I don't think we get refunds for these levies. So that's why this thing was changed to a levy. So there is no refund. And again, the issue of getting a house, Finance Act did not say that those who are earning 150,000 shillings will get houses, but these were guidelines issued by the ministry or by the State Department of House. So they were now trying to keep people were asking, then who will be eligible to get houses? So they came out certified using their own criteria that I may not know, that who get or who earn over 150,000 are people who can build their own houses. So those people are not going houses. But they said for those people who may be earning 100 shillings, then these people may get houses. And I'm using the word may get houses. The next one is on two jobs. When you have, so you're earning from two employers. Remember, the base is the same. Taking the gross salary of employer A, adding to gross salary of employer B. You add this up. This is the base of affordable housing levy. So whether they are put together, then 1.5, this is the same as one employer, employer A doing its bit and employer B doing its bit. So according to the employer, it's the same because we are talking about gross pay. and you are being paid by two different employers. I'm not sure whether I have left any, but I
Thank you,
think I
Sel.
have covered three.
Yes, let's just continue before I bring in Christine. There is one Hussein Janowala. He's asking that is there a limit regarding the implementation or use housing levy? How can one recover their funds if not utilized to purchase of a house? I think you have responded to that, but please hold on to that question. There is also an additional question. Miriam Mukoma, who asks, who pays the fine when the county delays the payment of salaries? That is Miriam Mukoma asking about the delays of payment of salaries. And lastly, maybe do I take another question or would you like to respond to those two?
No, just or give another one.
Okay, Festus was also asking a question similar to Miriam's because he says when of penalty for a late remittance, don't you think it is punitive to employees when they don't receive their salaries on time, especially county employees? I think their questions are more or less the same. Yes.
Okay, so let me address them. So legal framework, we expect that the Minister of Housing will come up with a criteria or a framework of issuance of these houses. And as I mentioned, KRA is a collecting agent. So all these other things will be done by the Ministry of Housing. Fines, who pays fines? When there is a delay in remittance of pay as you earn, it is the employer who is supposed to pay those particular fines and not the employee. Remember that pay as you earn is a form of withholding tax. When you are being paid your salary, then part of it is withheld. So who has the statutory obligation to remit it to KRA? It is the employer. So if the employer does not remit, then who should pay the 2% interest? It is the employer who is supposed to pay. I am not aware if KRA penalizes taxpayers or employees if pay as you earn is not remitted. And probably Polly can help me if there is something I have not clarified on that issue. I'm not sure whether I have left anything because that question relates to the question about counties and the lateness in payment of salaries. So thank you.
Thank you very much. I want to ask a last question to you, still on the housing levy, so that I welcome Polly to also comment. Modesta Shipuku is asking, for the housing levy, since it has been clarified that the levy will be deducted from the gross salary and not the basic salary as it was previously communicated, what will happen to the organizations that submitted July's affordable housing levy using the basic salary? I don't know whether you're in a position to respond to that question.
Kindly come up again. Just come up again. I think I didn't get it well.
All right. Modesta Shipuku is asking, let me ask the question just as it is.
Continue.
So Modesta is asking for the housing levy, since it has been clarified that the levy will be deducted from the gross salary and the basic salary as it was previously communicated, what will happen, or rather what happens to the organizations that submitted their July affordable housing levy using the basic salary?
Thank you. Thank you. So one is that there was no communication that I'm aware of that advised employers to use the base of affordable housing levy as, as basic salary. In the bill, there was a proposal that the base be basic salary. And again, remember in that bill, there was a proposal that the rate be 3%, if I'm not wrong. So when the act came out, and I think the act came out on 28th of June. This provision was to take effect from 1st of July. So if there was a communication that the basic salary be used as a base, then that was erroneous. Now, the treatment of this will be similar to those employers who did not deduct at all the housing levy. They will have to apply the correct base, then the correct deduction will be made. The employee and the employer will be required to pay the difference. So the base was wrong? Yes. Use the right base, get the difference between what was paid based on basic and what is supposed to be paid based on gross, and let the two parties pay it. Just like those who didn't deduct at all, because the Finance Act was still in court, you are still required to go back to July and get affordable housing levy from both the employer and the employee. Then have an arrangement of how that is going to be paid. Thank you.
Thank you so much for that response. Let me give you a moment to take a sip of water, even as I welcome Madam Polly to just continue to respond on this question. I see the housing levy has generated a lot of interest. Bernard Sowek is asking a question that if an employee has a secondary employment, for example, he's specifically asking about directors. So do they also pay for the affordable housing levy? Madam Polly, you're here with us?
Yes, I am. No one is excluded from payment of this housing levy. So if they're in the payroll, they have to pay the 1.5%.
All right, just a follow-up question. This is PUEA University. I'm not exactly sure who this is, but they ask this question. I have heard rumors that this finance bill, I believe they mean act, has cancelled payments for any unremitted pension or unpaid salaries that have been paid for a certain duration of time. So they're asking, is this true? They say that they are asking in light of so many unpaid dues, especially from universities. Would you care to shed light on this matter?
No, that is not in the Finance Act. It's not provided for in the Finance Act.
Okay, thank you very much. I think PUEA University, you have heard that. So then allow me to ask a question. This is, Christine, let me bring you in on this question. A pharmacy, are they required to use eTIM to generate receipts? Christine?
Yes. All taxpayers eventually actually will have to register for eTIMS. If the pharmacy is a VAT registered taxpayer, then yes, they will need to use eTIMS to generate receipts. Actually, where we are headed going forward, most all taxpayers will have to use eTIMS.
Thank you for that. Let me make a follow-up question. Albert Kinudia is asking, hi, I want to ask, has the pay for medical locums been increased to 35% for doctors? Maybe Christine, you can give clarity to that and even talk about secondary employees and the tax bans that are applicable to them.
Okay, thanks for that question. My colleague Polly had spoken on the revised pay-as-you-earn tax bands. So just as she had explained, maybe Maybe I'll just share my screen to the point where she had presented. Just give me a minute. So as you can see on that screen, so as has been happening up until you know, the rates have been between 10% to 30%. So like she mentioned, anyone earning above 550 Kenya shillings per month will be taxed at 32.5%, and any income above 800,000 shillings per month shall be taxed at 35%. So based on whatever earnings you're receiving, so you will gauge and see where you fall. And then coming to the question of primary and secondary employees. So if you have two employers, so your primary employer will be required to deduct pay as you earn on your pay based on the graduated tax bands as have been given there. So assuming you're on the highest tax band, assuming you're earning 800,000 per month from your primary employer, assuming you're employed by, let's say, Nairobi Hospital, and then you have locums at Karen or Mama Lucy, wherever. So we are saying you have reached the highest tax band of 35%. So any extra income that you're receiving every month, aside from the 800, shall be taxed at that highest rate. So whatever you're earning from your locums, assuming it is 300,000, aside of the 800,000 you earned per month, then your 300,000 will be taxed at 35%. I believe that is clear.
Yes, it is. It is very clear. I hope that you've gotten the answers for those asking about the secondary employee. I have a question here, even as I welcome, I know we have one of us from Taxpayer Services. Mr. Franklin is here. I have a number of questions to direct to him, and perhaps you can join into the sensitization. I will ask our host to please make him a panelist as well so that he can help us to respond to this. Then some questions, some of our listeners asking about making amendments to incorporate the housing levy. I'd like you to talk about return filing. So please be on standby, Franklin. I know he's right here with us. But I want to ask this question to Madam Paulie. Kindly elaborate holding taxes. One, Hussein is asking about part-time workers who do not have fixed monthly incomes, and he has again just talked about locum for healthcare workers. Just housing levies applicable to them. They do not have fixed monthly income. Madam Poli?
Thank you, Brenda. On withholding taxes, what I'd like to say is some expenses attract withholding taxes, and those are specified in the Income Tax Act. As an example, management fees, professional fees, which are above 24,000, attract withholding taxes. Contractual fees attract withholding tax. And now the Act now introduced withholding tax on sales promotion, advertising, and all that. Yes, there are certain expenses that are specified in the Act that attract withholding tax. And withholding tax can be final, or you clear the income and claim it as a credit in the return. I hope that is clear.
Yes. Please continue.
For locums payments which are not regular payments, I think Silas has alluded to this. When the payments are made to them, the housing levy kicks in. When you look at the Employment Act, the amendment there does not exclude anyone. There are no exclusions like for pay as you earn, where we say person earning below this amount of money, 288,000 per year, they're excluded. This one has no exclusions. So in a particular month where you earn an income, the housing levy kicks in, should be charged and remitted accordingly. Thank you.
Thank you so much, Madam Polly. Let me bring in now Mr. Ure. Just one question to you. Kindly explain what happens when one state parastatal deducts taxes from an employee, but that deduction fails to reflect on the iTax portal and therefore looks like unpaid principal tax. Would you comment on that, Mr. Ure? I don't know whether he's still here with us. We also have Franklin here from tax.
Yes, I'm still here with you.
Yeah, is
And I think the best person to answer that question is Franklin.
okay.
Oh, yeah.
No problem. It is fine. Let me bring in Franklin. I thought, yes, Franklin is right here with us. Franklin, a number of questions. One is that question that I have asked of unpaid, or rather, just as I have asked it, explain what happens when one state parastatal deducts from an employee, then it fails to reflect the KRA tax portal, therefore looking like unpaid principal tax. So talk about that. And then also Joroge is asked, how can one do ledger reconciliation? And the last question from one of our listeners is they are asking about enrollment to the MRI regime, that is monthly rental income. If it was done erroneously, then how can one be opted out of looking like a landlord when in essence they are not? Franklin, karibu sana.
Asante. Good afternoon, everyone. Please confirm that you can hear me.
Yes, Franklin, we can hear you loud and clear. I don't know how the weather is in that side of the country.
Okay, now I think the first question is answered by the second one, because there's a question on what happens for someone's pay as you earn, which has been deducted and it does not reflect on their ledger. And the second question wanted to know how to proceed with ledger reconciliation. So that second question answers the first, in that if your employer has deducted but your tax deductions do not reflect on your ledger, you need to proceed with ledger reconciliation. So how do we go about that? As a taxpayer, in most cases, we have, first of all, the authority has established what we call the Public Sector Division Office, an entity, an office that deals with public institutions. But in this case, then a taxpayer whose ledger reconciliation, or maybe ledger does not reflect all the payers you deducted from them, would need to seek reconciliation from their tax service office. So if you know any of the tax service offices that you belong to as a taxpayer, or should you not be able to visit your tax service office, then you can go to any KRA office and you'll be assisted with that, because then they would request for your ledger to be reconciled by station, assuming that you are taxpayer in Kisumu TSO, but you have got an office in Nairobi, you should be able to take from there, given that your PIN will just be forwarded and reconciliation will be of course it might take some time, but with that then you should be able to see your credits. So, and the third question now is on the enrollment of to MRI. So someone who enrolled MRI erroneously, of course there's procedure for cancellation of erroneously registered tax obligations. Included here is MRI. So again, that is dealt with by the taxpayers at their tax service offices. So you will be required to present some documents, because it would be you will be guided to tax service office by your account or relationship manager, and then the erroneously allocation will be cancelled as and when you provide those documents required. Thank you.
Thank you so much, Franklin. Still on your case, Janet is asking, how does one interest and penalties if there is no principal tax that is unpaid? Is that possible? And if it is, in under what scenario?
Yeah, interesting question. So I think is in line with what Mr. Silas Oure has been explaining. Now, remember that penalties are not only related to situations where there's principal tax unpaid. There's also a penalty for late or for failing to submit a tax return, whether the return had tax or not. If you do not file that tax return as per the due date, then you will be penalized for failing to do that. So yeah, that is one of the issues that would arise, or maybe that's a very good example of how a penalty would be if you don't have any principal tax to pay. So if you do not file on time, you will be penalized.
Thank you so much. I want to bring in Christine now. Christine, there's a question here regarding secondary employees. There's somebody who's asking if 35% is deducted from them, and yet the amount that they get essentially does not fall within that particular threshold, can they apply for a refund?
So they're saying due to overpayment of taxes from being taxed at the highest income band. Is
Yes.
that a question?
Yes, that is the question.
I'm not so sure how you would be taxed at the highest income tax band if you're not at that tax band. If your employer is in charge of deducting PAYE on your behalf, okay, I don't know how that would happen, but
Maybe let
yes,
me just
for any, just
in
clarify.
the case where I think their question, if I have understood them correctly, is this is a secondary employer, right?
Oh, okay.
Yes,
Okay.
and the 35% we know begins from 800,000. So assuming their income doesn't get to that amount, yet just by virtue of being a secondary employee, yeah, they still get 35% remitted. I mean, deducted from them. I think that is where their question is coming from. And this question is open either to you, Christine, Silas, and even Franklin. You can comment on that.
Okay.
Their question is just, can they apply for a refund? Yeah.
Okay. So for any overpayments, yes, you definitely should and can apply to the commissioner for a refund of your overpaid taxes. But like I had clarified, I also saw a question on someone asking, what if they earn 100,000? Will they be taxed on 35%? And I think I had answered them privately and said that
We lost you.
if
We lost you there a
earn...
bit. Maybe just go back a little.
Okay, can you hear me now?
Yes, yes. For a moment, your microphone was quiet.
Oh, okay. Sorry. I was saying I had seen another question also, someone asking about if they earned 100,000, would they still be taxed on the 35%? And I said, no. If you earn 100,000, you would be on the 30% bracket. That would be your highest bracket. So what I was trying to say is your primary employer will tax you using the graduated rates based on what you earn. The example of 800,000 and above was giving you was to show the maximum rate. So if you earn 100,000, of course you'll be stopping at 30,000. If you earn 24,000, for example, your highest tax rate is 10%. So if you're going to be paid any extra by a secondary employer in excess of 24,000, then it means, if I'm to use the example of 100,000, if you're earning another 100,000 from another employer, then it means that extra will be taxed at the flat rate of 30%. Your secondary employer is not going to be coming to graduate again using the pay rates. Your primary employer will use pay graduate and say on the first 24,000 per month, 10%, on the next 8,333, 25, on the next this March, 30%. They'll stop there and they'll remit from KRA. Your secondary employer will probably be paying you 100,000 again. So that is being added on to be taxed at a flat rate of 30%. It's not being graduated because we are saying you've reached the maximum for that band. That's what I was trying to clarify. I hope it's clear, the issue of primary and secondary employment.
Thank you so much. I don't know whether Mr. Ure would want to weigh in on that matter still. Okay, I don't know whether he's still right here with us.
Yeah, I think Majani has clarified, so I may not have anything more to add.
Thank you so much. I know our time is well spent. Wow. We can go on and on, but in the interest of time, we need to bring this to a close. Jude or Diambo or Ching. We also have the likes of Bernard Sowek, Kosivi, Afamvi. I think perhaps you are, says good morning. Perhaps you're from a different, I don't know whether you're in the country, but thank you so much for your questions. I want to welcome all our panelists today to give their closing remarks in this particular order. Franklin Kimutai, you will go first. Please give us your closing remarks, followed by Christine Majani, followed by Silas Oure, and finally, our very first panelist, Madam Polly Kefoi, will be the last to give us her closing remarks. Then we will bring this to a close. And this question, Madam Polly, as you are closing, you will respond to this one question by Bernard Sowek. He's asking, are affordable housing levy affordable housing levy deductible from daily subsistence allowance, for instance, per diem allowance? So that question is what you will respond to. Franklin, please feel free to give us your closing remarks.
Okay, thank you. Thank you very much, Brenda and team. I was a bit late to join this meeting, but I apologize for that. But thank you very much. And to our taxpayers, we hope that you get to comply. Should you have questions, kindly do not hesitate to get in touch with our team and you'll be assisted in any matter. Thank you very much.
Thank you so much, Franklin. Franklin is one of our very able tax officers from tax. Well, Franklin, I do know that you're now dealing with compliance matters.
Yes, and I have moved to Kisumu now.
Okay, he's now in Kisumu. We've worked for a long time with him right here in Nairobi, but thank you so much for that. Then over to you, Christine.
Thanks, Brenda, and thanks everyone for the opportunity to interact. The Finance Act 2023. We hope you've gotten something from this, and like my colleague Franklin mentioned, we are available for any questions. Reach out to your tax service offices. Thank you for taking the time out of your busy schedules to listen to us. I wish you a good afternoon.
Thank you so much, Christine. Let's appreciate her with the hand clap, even as I welcome Mr. Ure also to give his closing remarks.
So thank you so much again to our taxpayers for taking the time to listen to the amendments that were brought about by the Finance Act 2023. We are privileged to have you, and we will always be there to support you in any way possible. Have a good evening. Thank you.
Thank you so much, Mr. Ore. Let's have hand claps for him as well, even as I welcome Madam Polly to respond to that one question and give us her closing remarks.
Thank you, Brenda. I'd like to allude to what Silas talked about, what gross means for the purpose of the affordable housing levy is basic salary and regular cash allowances. So that is what will be subject to the 1.5% deduction. Then there's something else I saw in the charts that I think we didn't respond to. There was a person asking about the claim of mortgage relief on cooperative societies. What I'd like to say about that is that previously there were the institutions. Let me just get a bit technical here. Listed in the fourth schedule of the Income Tax Act. From if an individual takes a mortgage from those institutions, five institutions listed in the fourth schedule of the Income Tax Act, they could claim a mortgage relief. Because it's listed was not one of them that individuals could claim mortgage relief. Now, the Finance Act has now provided that individuals who take mortgages from cooperative societies can mortgage relief. Now, that said, I'd like to thank you for joining us this afternoon. I wish you a good evening. Thank you.
Wow, thank you so much. Today we have had very panelists. Kindly let's just show them appreciation. You can comment on the chat box. Let's encourage them. They have done very well. Done very well today in terms of demystifying, breaking down for us the Finance Act 2023 so that we can differentiate the rumors from what is true, what is false. And I'm sure you must have had a lot of clarifications from our panelists today. Let's comment on the chat box. Tell them how you found the presentation today. We have every intention of making our presentations customized to meet your needs. In that case, we have a link that we are sharing with you on the chat box so that you can be able to click on it and tell us which areas you want to be trained on, what you want to understand more. Kindly just feel free to take less than 5 minutes, actually, just a minute or two of your time to just tell us which areas would you want us to train you on moving forward. Apart from that, I just want to indicate that we normally make content available on our channel, that is KRA TV. Also, the link will be shared with you. When you search the word KRA TV on your Google devices or whichever device it is, you will be able to be directed to where we have resources for you, including also on the Finance Act, that is KRA TV. Remember that we also, like our panelists and my colleagues have mentioned, that we are available to offer any assistance that you might need on various channels through email. Some of you have been contacting us through Twitter, that is at KRA Care. We have a chat functionality also on our KRA website, that is kra.go.ke. So then that is it from me. I think the link has been shared on the chat box. Please don't leave immediately. Just take a yes. I see the link has just been posted. Please take a minute of your time to just comment on it. Thank you so much, our panelists, Madam Polly, Silas, Christine Majani, Franklin Mutai, and also our host for the day, Mr. Nelson. Thank you so much. I have been your moderator for the day. My name is Brenda Mutai. Let me wish you a very good evening. Thank you for being with us for those 2 or so hours. Have a very wonderful evening.